Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blikre, your host, and with me is Yahoo Finance's Allie Canal, who's here to ask the simple questions that sometimes fly right over my head. And today we're connecting money, jobs, and profits and what these mean for stock prices right now. Our phrase of the day is risk management. We lay down some simple guidelines for all investors to keep your portfolio safe. And this episode is brought to you by the number 446. That's how many companies filed for bankruptcies in the U.S. through July, the quickest pace since 2010. We're going to show the balance sheet tells that separate sturdy investable companies from the fragile high flyers. And today we are welcoming Brian Mulberry, who is a vice president and client portfolio manager at Zacks Investment Management with a 25 plus years in investment management. And he works closely with the research team, translating earnings-driven quant insights plus behavioral economics into practical portfolio decisions for clients. So Brian, we're going to dive into our phrase of the day, risk management, in a second. But how are you seeing the markets right now? It's been kind of a crazy September so far.
Absolutely. When I woke up this morning, the S&P was over 6,500 points, which means we're at another high. That's up roughly 10-11% on the year, on the heels of 25% last year and another 25% the year before. So in roughly 2.5 years, we're up 60% in this market. What's to worry about, right? Our view of that is there are some risks that are out there that we think are a little bit underappreciated in the moment.
Yeah, great. And so let's get into our phrase of the day, risk management, which kind of ties into that. Risk management is using simple rules to spot and size risks, diversify, set limits, and run what-if checks so that your portfolio stays durable in rough markets. And so just tell me, how do you think about risk management in your day-to-day job?
So risk management for us at Zacks is really baked into our DNA. We really look for, through our research process, profitability and momentum inside those profits. So who has good and growing earnings right now, but where is that earnings momentum going over the next couple of years? It makes sure that we don't buy into themes and memes. We want to work with real companies with real profitability at any moment in the market cycle. So risk management to us equates to profitability, not necessarily right now, but there has to be a trend line towards making real money for your shareholders for us to want to be a long-term buyer of that stock.
So what are the risks that you're seeing in the markets right now? You were just talking about how stocks are currently at record highs. Everything seems great, but there are some concerns underneath the surface, right?
Absolutely. The whole thing comes together when we were starting 2025, knowing that we were up 50% in 2 years. That return sequence was driven by too few names for us. That's concentration risk. So even as we sit here today, you have basically 10 technology stocks that are driving 70% of the earnings in this market. That was true last year. It's true again this year. They are very profitable companies. They have a large amount of revenue to work with, but for us, that's a very narrow slice in one sector of this market. That means the S&P 490 isn't doing as well. So if overall earnings growth for the S&P is roughly 10, 11, 12%, but these companies are growing at 24 to 25% year over year in earnings, that means, again, the bottom portion of the market, which is 490 stocks, is lagging in a material way. So yes, of course, you want to own these names, but in the right proportion to the rest of the market. In other words, if you own the S&P, you own a lot of bad stuff with a few good names.
All right. So you're kind of breaking down how to translate this concentration issue into real-time or real-world portfolio risk management. Kind of expand on that a little for us. So let's say I'm a passive investor and I have an S&P 500 portfolio. That means I'm heavily exposed to just a few names, these 10 names that you're talking about. What can I do to diversify or otherwise hedge myself against some future risk here?
Yeah, that's a great question. First thing is know what you own. If you own the S&P 500, you just need to realize that NVIDIA represents 8% of the market cap of the index. You add in the Mag 7 and a couple other names like Broadcom and Oracle that obviously is doing very well on a day like this. Now you're up to 50% market cap in just those 10 stocks. So you need to understand where your returns are coming from. Yes, you've done well, that's fine, but you need to know that. So what can you do to offset your risk in owning such a concentrated portfolio? Look for very high quality balance sheets in other areas that might be a little bit undervalued right now.
Tell us what high quality means, please.
High quality for us means, again, profitable, so good and growing earnings, but low debt on your balance sheet. That means that you have scale of your operations, you're generating a lot lot of revenue and sales from your customers, but that is translating profitably and efficiently through to the bottom line. So organic growth means that you have less debt on your balance sheet that you have to worry about, and you have good, strong revenue. So that's quality in our view at this point in time. Another measure would be short interest, low short interest stocks, meaning the market isn't betting against you as much as they are in other places. Those tend to be more stable sequences of return to own as an offset to the high energy, high momentum technology names.
But those names are probably a bit difficult to find considering we've been operating in this high interest rate environment.
That's
a lot
great.
of companies have a lot of debt. And we've been talking about the small cap rally that we've seen as we expect the Fed to start easing interest rates. So how do you really parse through and find those companies where there maybe are upside opportunities at a time when they've really struggled besides those mega cap names that really have the balance sheet to support everything?
Yeah, what's your screening strategy here?
I'll tell you right now, it comes with the theme that boring is best. They are not in the limelight. These are not the exciting names that you would typically look for, especially when we've got a new wave of innovation coming through AI. But boring is best. That's where these quality names live. And they're undervalued at this point. They're actually a sector like healthcare that's been really lagging the broader market does have some very good components. Do I want to own the whole sector? No, but there are some good names in there that I like. Financials is another one that tends to benefit in an easing rate cycle as well. Some incredibly strong names that live there at really good valuations that you don't have to pay the 22 times earnings that you're at in the S&P 500, but you can own those at like 15 or 16. JP Morgan being a good example of that.
Interesting. All right, so you mentioned some names and some sectors here. How do you think about this going into the end of the year? Would you stick with some of those names? What changes the game for you? Like when would you say, okay, maybe some of the risks are in the rear view right now and we need to adjust? What goes into that calculus?
So we definitely like the innovative cycle that AI is bringing. And we're asking a key question is who is monetizing AI right now? Lots and lots of capital, trillions of dollars being invested in AI directly in terms of model testing and development. But then you have the infrastructure piece, actually building out data centers, growing the power grid. There's real money there and there's real momentum behind
utilities,
earnings.
for instance.
Absolutely.
Huge one. So are you looking at utilities as part of the AI trade?
100%. And some industrials that benefit from the actual construction jobs from building these data centers.
The
right?
offshoots of AI.
Yeah, exactly. Right. And there's lots of ways you can go through that. Names that we like, Emcor, Amphenol, Caterpillar, John Deere, they're all going to have, their fingers in this pie of AI as this capital starts to get distributed. They're AI adjacent, meaning they're benefiting from the investment, but they're not AI companies alone, a way to barbell your risk. So you can own technology on one side, but have industrials, financials, and healthcare on the other side.
Are the AI tailwinds enough to offset any potential weakness that we will see or that we're currently seeing when it comes to the economy? We've got those jobs revisions. They weren't great.
Yeah.
There's stagflation jitters that are emerging now with markets. But is AI at a point where it doesn't really matter what happens right now, at least in the short term?
That sounds like
the
a scary proposition.
Yeah, and I am afraid of that. Absolutely. I think it has carried us to this point with some real good results. There's no question about that. Oracle's results today is a real example of this, where quarter to quarter, 77% growth in their pipeline, right? That's
$100 billion in one day for Larry Ellison.
It's a really, really
Richest
big
man
deal.
in
And
the world.
it's real money. Okay, but that's a very narrow slice of a big part of the pie. So what bothers us is if there really is weakness in the economy that's developing and we don't see the actual commitment of capital through, meaning Microsoft alone, couple hundred, almost $300 billion from last year and this year in growing AI. If they say, hey, wait a second, there's softness in the economy, we're going to pull back. We're going to save $100 billion.
They're not immune. The Mag 7 is not immune.
No, not at all. And they may very well say, hey, look, things are getting tight around. We're not going to spend the amount of money that we said we would, which has happened before. If we go back, to the tech bubble in the late 90s and things of that nature, there are periods of time where it doesn't play out, We've talked to our clients all the time. Remember, 20 years ago, the biggest internet company on the planet was AOL. And they're not around anymore.
Well, they're in this building, to be sure. we kind of, they're our sister company here under the Yahoo Inc. umbrella. Yeah. But to your point, they bought Time Warner and, well, that was a different era, wasn't it? I want to ask you, we haven't talked about tariffs yet. the fundamental backdrop with this new president, well, he's not really a new president. President Trump has been around for a while, but we're just starting to see the effects of tariff kind of take hold in the economy here. It took several months for the data to shake out. We've seen the weakness in the labor market. How do you think of tariffs impacting the economy and some of the recommendations that you're making, some of the screenings that you're making for stocks?
Absolutely. It's something we've been watching very closely. And there's some other data that you can look through to kind of parse through this and get a finer look. And when you look at retail sales, which is really what consumers spend on a monthly basis and a year-over-year basis, there's a lot of durability there. We've seen roughly the same volume of dollars spent on retail goods. Now, what they're buying is changing a little bit. I think that's due to some behavior change by tariffs. There's less appliances, large electronics, things that have been from more tariff-driven areas geographically. And so consumers have changed their behavior to a certain extent, but they're still spending the same level of money. Then we go to something like the PPI report that we got this morning, and goods inflation has been, I think, softer than expected. What we have seen and what we can look through at Home Depot earnings, Walmart earnings, and things of that nature is that there are some cost differentials for some products, but they're not making it through all the way to consumer wallets. Again, in certain areas, big ticket items that are more discretionary type of purchases, yes, they're there and consumers are buying less of them, but there's also some more rate sensitive areas that are developing weakness as well. When you look at things like trucks and cars and leases and things of that nature, things that you have to finance. Look at home purchases, all of that kind of stuff. So what if the inflation that we're worried about is actually being driven by high interest rates alone? That's a question that we're looking through on the basis of this data as well.
And real quick, as we're talking risks, you brought up the dot-com bubble.
Yeah.
And bubble risk, that's been a conversation point on Wall Street. Are we approaching bubble territory? Is the market too frothy right now?
Not yet. We feel like that there is enough profitability and real revenue that this is not a bubble. What you would really worry about is if we were starting to see share price appreciation, the market just going straight up with no profitability. That's an asset bubble that you would be concerned about. At the moment, yes, it's frothy. 22 times earnings is a strong valuation. Historically, it'd be 17 or 18 times. But there's enough real profitability and earnings growth out there to justify that current valuation.
All right, we're going to continue the discussion with earnings in a minute here, but we need to take a short break. Coming up, we're going to be talking about ballooning corporate bankruptcies and a runway battle that takes to the football pitch. Stay tuned. This episode is brought to you by the number 446. That's how many U.S. companies filed for bankruptcy through July. And that's according to S&P Global Market Intelligence. So what does this signal to you, Brian, if anything? Is this a yellow warning flag, an orange, a red?
Definitely a yellow light for us because you had 71 bankruptcies in July alone, which tells us that not only is the pace sharpening, it's steepening as of the most recent measure that we have. This is the second risk that concerns us the most at Zacks, which is interest rate risk. What we know is that when rates go high, they tend to erode the value of future earnings. It's just like when you're trying to buy a house. When mortgage rates go up, you can afford less home because more of your monthly payment gets dedicated to servicing the interest.
Sure.
It's the same thing for businesses. We've had kind of a dearth of IPOs recently because it's just too expensive to finance the operations of going public, right? And so that's been a weight on the economy on the downside. These bankruptcies are just large public companies, and they're starting to erode under the weight of higher for longer interest rates. It's a risk, again, that's not impacting the higher quality, high-flying names, but for the rest of everybody else out there, it is a real big concern.
For those companies that are filing for bankruptcy, what's the common denominator? Are they concentrated in certain industries, or is there a common thread there why they are folding like this?
It's the common theme is just carrying too much debt into this rate hiking cycle where they've just really been under the weight of that leverage on their balance sheet. It's not really specific to any one
Broad-based.
sector. It's pretty broad based, right? We've seen it impacting everything from dollar stores, right, to some of the more, I would say, discretionary items as well that are out there. So it's across the board, this interest rate risk. That's kind of living more in that S&P 490 that we were talking about earlier today. That's where that risk lives.
I want to ask you, go back to, you were talking about the S&P being at 22 times forward earnings. Just quickly break that down for us. And then what would it mean if we approach a more normal valuation? Because that implies a steep drop in the stock market.
It would, yes, just on a pure point value. So what we're looking at as a way to value where the market currently is looking at the total price, which is $6,500, divided by its earnings, which at the moment is around $270 per earnings. If that's where we'd get the current PE. We want to look 1 year ahead because the market usually is pricing in events on a forward-looking basis, 6 to 12 months. Well, we're expecting next year's S&P earnings to be somewhere around $295 to $300 per share. And so if we're at the same 6,500, that's where we get that roughly 22 times earnings valuation that we're looking at right now. Historically, if we were trading at 17 times earnings, it wouldn't be 6,500 points. We'd be closer to 5,000.
And that's what kind of a drop is that? That's 20, 30%.
That's a lot.
You're looking at plus 20 plus, a bear market type, event like what we saw early in April after the tariffs were announced.
And just a quick reminder that we don't always get back to market highs within a few weeks.
Indeed.
Yeah.
Yes, that is true.
Well, and I'm curious, going back to bankruptcies, if you're an investor, how do you really assess whether a company is heading in that direction? What do you look for in earnings or even just general commentary to kind of give you the green light? All right, maybe this is a company or area that I don't want to be involved with.
Yeah, absolutely. For us, we could just follow the data, right? We can look at publicly traded companies and we can look at what their earnings have done over the previous 4, 5, and 6 quarters and see what the general trend is. If they're just treading water on their top line revenue, but their earnings are going down, that means that they're not doing a good job of managing revenue through their balance sheet. So then you want to ask the next question, where is that going? Where is the patient bleeding on the table and how can we stop it? If there's no answer, if it's just simply that they're paying too much back to service that interest, there's no way forward for them to recover,
Yeah.
right? And so that's really what you would worry about is you want to look at those trend lines in the real data. So we can find some companies that are under pressure, undervalued because they had a bad quarter, but the general trend was still fairly healthy. And then our research process takes us into the next 4, 5, and 6 quarters into the future and look at where does that actual earnings trend look like? Does that profitability recover? By how much? And compared to its peer group, is that better, worse, or the same? And so we have a lot of different ways to evaluate what the individual stock is looking like today, where it came from, where we think it's going to.
I really like this discussion about earnings. So I got one more because everybody's talking about the Fed next week and CPI tomorrow. CPI will be out by the time this airs. But let's talk about earnings because we got that coming up in about 3 weeks. The big banks are going to kick off. What should investors be watching in the early innings here? We're talking about early October. Any warning flags for investors?
Well, just a reminder, what happened a year ago. We got a 50 basis point cut in the September meeting from the Fed, and the 10-year Treasury went higher. That's
unusual, very unusual.
Yeah, and it's meaningful because short-term rates don't set mortgage rates or car loan rates. It's the 10-year Treasury. So people thought that we're going into an easing cycle, things are going to get cheaper, and they didn't. There's a similar backdrop that's out there. The question is, okay, we're all expecting a rate cut next week from the Fed, but what's the language behind it? There is such a thing as a hawkish cut where they could simply say, we're cutting because we feel like we're a little bit behind the curve. There's more weakness in the labor market than we expected.
And to that point, 10-year yields, 3-year yields, they did spike on those revisions.
Indeed. So with that in mind, we're with same kind of a backdrop. So yields on the 10 and 30 year are more important than what actually happens next week. And that will be driven by the language in the market. What does that mean to earnings? Again, it's the borrowing cost that matters. If you're a bank doing things overnight, then business gets immediately cheaper. That favors those big banks going into Q3, Q4 earnings. One of the reasons we like the sector and how it's valued right now. Other places, if you're still leveraged, it might not be the relief that you're looking for. If you're trying to buy a home, it might not be the relief that you're looking for. So expect volatility in the short term. We do expect rates to move lower over the next probably 4 to 6 months. But in the meantime, it's going to be the language around those cuts that might move markets more than people are expecting.
Excellent advice there. We got to save time for tonight's runway battle because it's hitting the pitch, something for all you soccer fans. On the left catwalk, we have the goalkeeper balance sheet, net cash, laddered maturities, and free cash flow that punches away rate shocks. And on the right, we've got striker leverage, fast growth, heavier debt, and a scoring streak that depends on cheap credit and momentum service. With bankruptcy rising and valuation stretch, which kit holds up in extra time? Brian, tell us who gets the captain's armband this quarter. Is it the goalkeeper balance sheet or the striker leverage?
Well, we all know strikers get all the glory out there because of the way they score goals, but defense wins championships. That's also true for investing. If you are defensive in this moment in time, be a little bit more cautious about some of these downside risks that we've discussed. You'll have a way to navigate the short-term volatility and come out ahead on the other side.
Who's the striker and who's the defender right now, if you had to pick?
Well, a striker for sure is Oracle right now. They're absolutely monetizing AI in a huge way. And my goalkeeper, I would go back to JP Morgan. They just are the biggest retail bank on the planet. They're well positioned with a diverse range of products to benefit from whatever rate cut happens. They're just in a great spot.
And speaking of JP Morgan, CEO, he was talking about how the economy is weakening. He's not sure if that means recession or what the long-term implication is. And you were alluding to stagflation, right? When you were talking about what the Fed language is. So what are your expectations when it comes to the end of the year into 2026 for the health of the economy, the odds of stagflation, and whether or not we can really get over this hump?
I think it's a great question. And for us, we just go back to the data, right? And the most important number when it comes to stagflation is job growth. If we're growing at roughly 100,000 jobs per month, that's pretty much the standard 1% growth in the job market that we would expect in a normal, healthy economy. We've been below that. We thought we were above it, but the huge revision that we got means that we were actually below that 100,000 level. This is why the fears of stagflation are starting to materialize in a more prominent way. Growing jobs out of that back over 100,000 is the key to make sure that we don't fall into this kind of flatline recession.
But with the immigration crackdown and everything going on, is that still possible? Can we hit 100,000 consistently?
Yeah, of course.
Yeah?
Yeah.
Okay.
All right. We have about a minute left here. I just do you get the final word on a risk management statement to investors out there, people just kind of getting their feet wet in the markets? What do you have to say about that?
You know, it's an exciting time. It really is. There's a lot going on in this market. There's a lot to kind of accept day in and day out. But really, just be focused on the small details. Know what you own and know why you own it. Don't get caught up with all of the noise. Try and find the signal. For us, that's always in the math. The data matters. It will show you where you need to be invested and, more importantly, where you don't want to be invested. That earnings trend works both ways. We know exactly where growth is happening company by company and also sector by sector, but it also gives us the other side of the data where we know weakness is developing because we see a decline in earnings company by company and sector by sector. So just simply know what you own, know why you own it.
I love it because the Fed is data dependent, so should investors be. And we got to wrap things up here, but just a quick recap. We were talking a lot about risk management and all its various facets and how you got to step back and you really got to pay attention to the data as an investor. And we also talked about the rise of corporate bankruptcies and how the concentration in the market favoring just a few companies. So if you think you own just the S&P 500, guess what? You're concentrated and maybe it's time to look at some other options. We also talked about some screening methods to find those other stocks in the market, aside from those top 10, that do have those strong balance sheets. And so having said that, guess what? We got to wind things down here at Stocks in Translation. Make sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcasts. We'll see you next time on Stocks in Translation.